have ourselves a little bit of a rebound. We start the week with a little bit more life in Wall Street's performance than we saw toward the end of last week when all looked dismal and all looked bleak. So do we have on this holiday shortened week the seed of a rebound for risk sentiment? That's what we are going to tackle here as we look for what is going to be coming at us here in these next few days of action ahead. This is Macro Money. I'm Ilya Spivak, head of Global Macro here at tastylive. And what we're going to do is, first and foremost, as usual, take a look at the performance for the markets this past week and see what that price action might tell us, and then take a look at how we've started so far and what might be next, at least as far as the price action seems to be suggesting. So here is how we did last week, and not surprisingly, it is painted top to bottom with red ink here. Stocks down aggressively, S&P off 2%, NASDAQ 3.1%. Yields down across the board as we get the bonds finding, once again, a sort of haven bid. Crude oil down, gold relatively steady, interestingly. There was this period over the past several weeks where gold was very much acting like a risky asset. Last week, the selling seemed to have reached fever enough pitch that gold seemed to have once again rediscovered at least some degree of anti-risk support, as it episodically does. And although it declined meaningfully less than a lot of the other overtly risk-linked assets, to some extent even crude oil, although it has been moving much more to the beat of its own drum. The dollar broadly higher to give the risk-off mood still more credence. Euro off almost 1%, yen down 1.2%. That's despite a little bit of a rebound toward the end of last week, as it started to look like maybe the yen was a bit overextended on the downside once Japanese officials started to come out and scream loudly at reporters about maybe they're going to intervene into the market. Bitcoin, though, off by double digits, 10.4%. That's after a 9.3% decline the prior week. So very clearly a risk-off vibe last week, almost single-mindedly so. And that's despite the sort of things that we saw last week being generally supportive of risk sentiment. And of course, chief among them, the earnings out of NVIDIA that gave us almost 24 hours of a sentiment rebound, which only came to crater by day's end. So we have this very capitulation flavored intermarket layout here. Obviously, these moves are not capitulation magnitude by any stretch, and the markets are still much closer to record highs than they are in any kind of free fall. And indeed, we start this week with a much firmer tone. So starting off here, sentiment holds up pretty much from the open over the weekend, where the futures markets come alive with Asian and Pacific markets, and the momentum pretty much held up all day. S&P up 1.7% almost, NASDAQ up 2.8%, yields in a bit, a little bit more pep out of crude oil. Gold, though, posting a meaningful rise of 1.23%. The euro relatively steady. Yen, again, a little bit lower, although the degree to which the yen is sort of following the beat of its own drum here seems to be increasingly on display. It isn't necessarily as tied into the narrative as it might be under normal circumstances because of all of the issues around threats of intervention and, of course, the one-sided action we've seen in the yen sell-off up to this point. And that, of course, around the idea that new Japanese Prime Minister Takaichi Sanae is going to pursue a very expansionary fiscal policy in addition to some new found pressure on the BOJ to abort raising rates and to stay relatively dovish, a sort of retread of the Prime Minister's mentor Shinzo Abe's policies to a large extent. And with that, of course, aggressive yen weakness, as was the case when Shinzo Abe did something similar when he was the Prime Minister. So the yen may not be the barometer it usually is at this very moment, but clearly a risk-on vibe here, and clearly that vibe echoing something to do with a friendlier view on Fed policy, yields in, sentiment celebrating that yields are in, gold up, dollar soft, at least biased soft against most of its major counterparts. Though again, against the euro, it's very modestly lower, barely any selling to see, but ever so slightly. And not surprisingly, sort of looking at the telltale signs in the price action here, if we look at the evolution in Fed rate cut odds for this coming meeting on December the 10th, what we end up seeing is that the markets have once again found their way into thinking that a rate cut is much more likely than not. And that's really the story that we've been watching here since October the 29th, and it's the story that continues to be the only real thing with committed consistency in these markets recently. Going here into what's happened with Fed policy expectations, and we'll take a look at these numbers here in a little bit more detail as far as what's being called for in a moment. But we can see that since that October the 29th Fed meeting where we got that second cut, this was where Jay Powell signaled that maybe December was not nearly the foregone conclusion that markets thought, and we got this pullback. And we can clearly see that this has really been animating the story, because through this pullback, we've had relatively solid earnings overall. We've had the third quarter results for the S&P 500 give us a 13% year-on-year growth rate for earnings. Very solid, if not strong. Tech understandably outperformed, 27% year-on-year growth. That's despite the very sort of loud miss on Meta amongst the Mag 7 earnings releases. Now we have all 7 out with NVIDIA last week, and the results don't look weak. At the same time, the economic data seems generally well supportive, such as it is. Obviously, the government shutdown has derailed much of that data. But just last Friday, we saw the latest numbers on the S&P Global PMI numbers, and what we see here for November is by no means soft. We see a rebound in the service sector, which is, of course, the largest part of the economy. We can see the composite index that takes in both manufacturing and services tends to follow services to a large extent because it is so much more represented as a share of the overall economy in the U.S. And we can see that we're looking at the same multi-year highs or similar multi-year highs here as we did in late 2024, which at that time looked like the strongest level since back here, early 2022, before the Fed went on its rate hike bonanza. So as we look at what's going on here, from this measure at least, it doesn't look like the economy is in a particularly terrible shape. So earnings are good, economic growth is good, or so it seems, such as we can tell from the data that's there. The situation with the escalation between the US and China that everybody was so worried about in the beginning of October, that's been largely unwound, at least for now. The government shutdown is over. And so one would think much of the things that ought to be holding this market down have been taken off the table at the very same period that the market is trending down. And the only thing we're really left with is this evolution in Fed policy expectations, which on a day like we see today clearly has shifted to a more favorable view for markets. And that perhaps explains some of what we see. Now, we should note we did get a little bit of a worrying set of consumer confidence numbers on Friday as well. But on the whole, it doesn't look like the markets were prepared to really jump out the window on this just yet. Nevertheless, it is worrying that even as we have 1 year inflation expectations declining, something that might have been a lift for sentiment really at any point since early 2021, where we can see very clearly sentiment is a creature of inflation expectations. When they're building into the COVID tops here, sentiment is declining. Then the Fed gets serious about rate cuts, inflation expectations fall, and sentiment improves. Then, of course, we get the tariffs at the beginning of this year. Inflation expectations surge and sentiment falls again. We have since, of course, moderated considerably. But over these past 4 months here, that moderation has not helped improve sentiment. And this is maybe a time bomb waiting to happen. But again, looking at where overall growth levels are, this does not look like it is at this point becoming an issue. Now, this is where things get interesting this week. It's an abridged week. We have relatively thin liquidity likely as we get closer to the U.S. holiday. And so as we look at those market closures, we're going to get a little bit of economic data. Most of it is going to be terribly old because this is still backfill from the shutdown. But perhaps this will give us some sort of steering on where this goes next. We start with the September PPI report. Expectations are that we're going to get a rise of 0.3% month on month. We also have retail sales, again, for September, so quite old, expected to rise 0.4% after a 0.6% rise in August. Durable goods orders also due on Wednesday. I might think by then we're relatively settled into some kind of autopilot going into the holiday, unless something has gone wrong on the sentiment front. But nevertheless, it is on the calendar. And of course, we have an assorted number of releases covering October, covering some of them in November that might be released, but we don't know because we've not seen official announcements that any more catch-up data is in the offing this week. For the PPI numbers, doesn't look like the shallow rise month on month expected is going to really dislodge the trend here, as we'll be able to see it again only through September, it looks like, where it looks mostly like wholesale inflation is anchoring. perhaps most importantly, what it isn't showing is that there is a significant build from the tariffs that has over time made its way into higher wholesale inflation, with the expectation that it would then have some knock on for consumers. So looking at this here, at least it doesn't seem to scream like this report is going to derail something about Fed rate cut expectations if we see something within the realm of recent outcomes. Now, of course, we might see a shocking surprise, but that's not the likelier outcome almost by definition. Looking at retail sales, the rise that we're expecting will be a little bit narrower than some of these numbers that we've seen. But so we can see, this is not the world's most controversial series. In fact, the month-on-month rises have not, again, shown a dramatic drop-off around any kind of sign of acute deterioration in the economy. In fact, if we look at the year-on-year retail sales numbers, they've been creeping higher. And the rate of year-on-year growth for the latest numbers that we have, which is August, matched some of the highs of the year, which in turn were some of the highest since late, let's call it mid-2024. And so we're looking at relatively supportive looking numbers here. And of course, consumption is the meat of the economy. So there's some disconnect here, seemingly, between this and what's going on in sentiment. And again, sentiment is much more current than the data that we have on retail sales. Perhaps it just hasn't reflected it yet. And so if we were, for example, to see a sharp decline in September, as the consumer sentiment numbers would have us think might be the case, would that just solidify Fed rate cut expectations more and encourage the markets higher? Maybe, if that's, once again, their bogey of choice. Now, as far as overall expectations go, we can see the rate cut does indeed seem to be creeping back into this year's Fed funds pricing. For next year, we're at 68 basis points, so still well in excess of what the Fed is anticipating. The Fed is only calling for a single rate cut next year after 3 this year. And so the question then becomes, beyond this kind of cheer that we see today, is there more here, considering the markets are already more dovishly priced than the Fed is for next year, whereas delivering on December would only just meet the Fed and not overshoot it from where the barometer was established in September. So, could this be the start of a rebound with legs? Perhaps. But might this still be the kind of corrective thing that we've seen on the way down here? So far, we just don't know. Looking at the US dollar here, it, like stocks, has not dislodged from its recovery started in mid-September. And if nothing else, this raises the question, if in fact we're getting more dovish on Fed policy expectations and the markets like it, and it's a risk-on kind of a response, why is the dollar not weaker? Why is it not turning? And that's one of the tells that might be ultimately very important here. The dollar has been acting as something of an anti-risk kind of asset. It's held up here very tellingly, even as the rate cuts have started. In fact, it started to rebound as the Fed finally got underway, and it seemed like speculation had become reality and there was nothing else to do there besides what was already priced in. And so the dollar had no more downside catalysts. If it can't start selling around a rebound in risk, well, then the rebound in risk might well be suspect. So with that in mind, my exposure here is not very much changed from where it was last week. I am long gold. That's working a little bit here. Short the major currencies against the US dollar. There's that US dollar holding relatively steady today. Still short risk. Obviously, we've had a meaningful rebound here. Bitcoin, which is this IBIT ETF, we saw meaningfully higher. Russell too, S&P as well. So that's a move that for me still looks corrective, but obviously could be more than that. And I'll be on the lookout to jettison this exposure before I give up any more gains in substance. The view on bonds still seemingly constructive and a little bit more progress here today. So I've pushed out my duration on this position now to 53 days on the counter. So intending to hold this for a while yet. I've added a long side exposure in silver last week, still looking for the precious metals to continue higher, essentially around what we just talked about momentarily, this idea that they held much firmer last week than did overall risk. And that seemed maybe telling of what is a newfound resilience amongst risk aversion. And still a little bit short oil here. The overall direction continues to kind of edge down despite the rebound we saw today. See if there's more to it or if that was really it. And that is macro money for today. As ever, we are here Monday through Thursday, right after overtime, a show that I co-host with Dylan Radigan and Chris Vecchio, looking at the Wall Street close and where things may go therefrom. Short week this week, though, because of the U.S. holiday. So we'll be here today and tomorrow. Then Monday, the week after that, is when the show returns. If you are watching this on YouTube, like and subscribe. I am also commenting at Ilya Spivak on former Twitter and on Blue Sky and writing for the news and insights portion of tastylive.com. Macro Money is back tomorrow. In the meantime, happy trading.